insurance. Thank you. So I'm gonna do this from downstairs. I'm already tall enough, and it's too late. So I know, first of all, thank you for being here. I know I am keeping you away from your first drink, hopefully not your last drink of the day, that is going to be coming up. So thank you for being here late. We're going to talk about lead optimization in auto insurance. And there is a very specific industry here, but hopefully you'll find applications across the areas you are interested in. But before that, what I want to do is talk a little bit about who Merkle is. You guys know, anybody knows Merkle? You've seen it before? Excellent. And my clicker. Here is my clicker. Okay, so Merkle. We're about 2,000 people, privately held, the largest privately held CRM agency in the US. We have about 150 hosted, 150 clients. We manage about 140 marketing databases. We optimize close to $10 billion in marketing spend yearly. There's about 2,000 of us distributed across the US and globally, in London and in Shanghai, where our global operation is for delivery. Primarily focusing on data, technology, and analytics in helping our clients drive differentiation. Our value proposition is helping clients utilize first-party data to create differentiation and bring their customer at the center of their marketing and business strategy. So this is kind of like how we believe analytics is helping our clients. We're organized in specific verticals, and we believe that getting knowledge across different industries and actually infusing analytics with industry knowledge is what creates differentiation. So we have areas of insurance, retail, banking, media and entertainment, life sciences, nonprofit, and high-tech B2B. We also have specific capabilities that we integrate across verticals to create best practices. Some of the biggest brands in the world are our customers. This is some of our biggest relationships, and primarily, as you can see here, technology, B2B, insurance, wealth management, and pharma are very heavily represented, and I can talk to you about some of them in private later on if you need to know details. Again, we are global. We follow talent, especially analytic talent, and we also follow our clients. We have offices in multiple locations. Our headquarters are in Maryland. So a little bit about the project. So I gave you a little bit of an overview about Merkle, but I want to tell you a little bit about the project. The project is actually being implemented in Japan. So do we have anybody from Japan? I want to make sure I don't insult anyone, and if I do, I apologize in advance. We don't. Great. So I can make up stuff. So the project is in Japan for a major insurance company. And the reason we chose this project is not because necessarily the statistics are too complicated. You all probably have done this before. We found out that the project is very interesting because it's an example of how we can create value by transferring IP globally. Okay, this is a global company. Some of the stuff that they're doing here in the US are not getting transferred. But even if you take some very fundamental, basic principles of analytics and you employ them in an environment that is very open to change, you can really create substantial benefits. And I think for me, that's a very big part of this case study. It also demonstrates that you don't have to kill a mosquito with a nuclear weapon. You can just go and apply something that is very specific to the market based on what the data allows you to do and based on what the environment allows you to do. So a little bit about the market in Japan. Specifically here, we're talking about auto insurance, okay? I know it's not the sexiest thing ever, but it makes a lot of money. So if you do it right. 3 major locations actually generate almost 50% of all the policies. This is where all the automobiles are. And they also represent about 60% of the population. Basically Osaka, Nagoya, and Tokyo. Those are the 3 areas that everybody's actually competing. It's a very competitive market. It is also a market where there is no customer data. Okay, that's very important. It's also a very regulated market. As you guys know, insurance in the US is very regulated, but it's also very regulated in Japan. So when you start doing analytics in a very regulated environment, it's very important to be able to understand what data you can and you cannot use. And it's also very interesting how clients themselves have created an environment where consumers are actually now behaving differently. You need to account for that. And we're all statisticians or mathematicians here, but understanding the consumer and how they behave is extremely important. Specifically in Japan, consumers for auto insurance, they shop when their policy expires. Here in the US, consumers shop all the time. We have created that, so doing analytics and doing modeling allow us to understand who is shopping. In Japan, it's all about being able to find out new customers and also find out customers where their policy expiration date happens, the so-called X date, for you guys that know that. And last time we were in Japan, we found out the X date is actually called monkey. So it's all basically about finding the monkey and being able to predict when someone is going to be shopping. So X date is an important, very important factor. Now, very big growth in automobiles, so new policies are coming into the market, and that's what everybody's going after. Very small direct-to-consumer market. The majority of the people are shopping through agents. The customer wanted to have a big impact on the direct-to-consumer, which is now representing about 7% of the market, extremely small. If you look in the US, the auto market is completely upside down. There's a lot of auto direct sales for insurance. Very growing market, about 7% growth annually. You also have about 30% new automobiles, which also represent a very big opportunity. From a total spend perspective, in Japan, about $60 billion advertising. The majority of that is on TV and obviously digital. There's still also a very big part of what we will call traditional media, newspaper inserts, DM, and all the other good stuff that people here are trying to phase out for and move into digital. It's important because this project actually is looking to capture a lot of that digital activity that happens in a very specific way. Customers go into aggregators, and companies like our client competes in real time with other insurance company to get that lead based on the information they have, and they make a determination if they want to buy that lead and serve a quote, or if they want to let that lead go to someone else. So very big market and big opportunity. My colleague Yanni is going to talk to you about the details of the project. And again, I think it represents a good example of how to do appropriate level analytics and not overcomplicate and get incredible results, because you're doing it in a market that is actually now at the beginning of analytics and utilizing data to be able to achieve results.
Cool. Thanks a lot. So basically, Yanni kind of set up the context of the insurance market in Japan. So the way the lead buying was happening was, if you look at the left-hand side, when we sort of first started to learn about the business, again, it's a little bit of like cultural learning as well, because we were not very accustomed to how the lead buying market works in Japan. But what we sort of managed to do is, after a whole lot of conversations, kind of represent this through a very simple schematic here. So what was happening was, on the red column was the lead aggregator was basically, getting all the leads, and our client had some very simple business rules, and these business rules were could have been based on precinct in Japan, where they were not actually allowed to write for insurance. There were certain areas that they were trying to avoid. There were certain age groups that they were trying to avoid, but very simple business rules. And all the leads that were passing those business rules, our client was actually ending up paying for those leads. So it was not obviously a very sophisticated model. So once we started looking into this, what we figured that, we could actually start talking about, and again, the modeling here is not the most critical part of the solution, but convincing the client that, hey, we can do something better. And also, it's a very traditional society. The business like this probably has been happening for the last 20 years, and there's a lot of personal relationships that were extremely important. So what was more important to do here was to convince the client that, hey, why don't we actually try and qualify the leads before you pay for them? It's a very, very simple question, but in order for us to be able to execute that, there was a lot of conversations that need to happen. Basically, our client actually had to go back to the aggregator and tell them that, hey, we are not going to buy 100% of the leads that you're going to provide to us. We are probably going to buy only 60 or 70% of those leads. So once that environment was created, what we did was we created sort of a very simple two-phased approach. And by the way, simple, I'm meaning it's not really rocket science, but the way we kind of scoped it out was the first version of the model was decision tree. It's a standard IBM SPSS module-based decision tree that we use. And one of the reasons why we chose to use that particular software was it's very good at creating simple models based on raw data. And one of the main things that we were trying to make sure that we satisfied was that we could not have made the scoring code extremely complicated. So the first round of the model was actually based on fairly a scoring code kind of generated from as raw data as possible. Basically, the data that they were collecting from the aggregators without a lot of interaction effects or direct data variables, just to make sure that we could actually implement the scoring correctly. Once that happened, and we deployed that, and there are some results of what the model did in the marketplace in the later slides. But once that happened, we also started collecting results from that particular deployment of the chain model, and also simultaneously started to look at the validity of the model scoring in real time, and made sure that the scoring was being done correctly. And then once we are satisfied that, hey, the scoring is being done correctly, there is sort of technical capacity to probably introduce a little bit of a more sophisticated level of modeling, we went to a regression model that actually increased the performance of the chain model by a significant amount. So I wanted to talk a little bit about some of the challenges that we saw, because this client they work with quite a few aggregators, and in the study we considered 3 of the main aggregators. They supplied about 90 to 95% of all the leads. So the challenge here was that not all the aggregators were collecting the same data. So there were some critical data elements that all of them were collecting, name, age, gender, a little bit of driving history. But there were different variations of data fields that each of the aggregators were collecting. And they had their filtering based on their unique variables or attributes that they were collecting. So the first thing that we had to do was kind of get all the data from all the aggregators and kind of do a lot of very significant data mining, data cleansing, standardization to kind of create an analysis data set which was basically normalized and standardized so that we can look at pretty much all aggregators at the same attribute value level. So this actually took a significant amount of time because the data was a little bit unknown to us, and then we actually had to go back and talk to the aggregators and figure out that what are the different levels of coding that they are using for different types of data. But this was a very essential process, because without this, our model would have never been robust. So for the decision tree based model, We don't actually have the variables which came into the model because that we think is a little bit proprietary to the client. But some of the results that you're seeing here are real results. So what we did see was that from the application of this chain model, we could capture almost 85 to 90% of the leads by suppressing 85 to 90% of the conversions by suppressing about 30% of the leads, which were unproductive. So, at the very first step, within the first 2 weeks of the validation, we thought that, this was a major win. So basically, the message back to the client is, you could pretty much get as many conversions by spending 30% less money, which was obviously huge. But another, which was a very pleasant surprise that we found, and which actually had bigger implications for the business, was that this client was actually using business rule-based suppression. So, like I said, they were suppressing people from different areas, they were suppressing people from different age buckets. But what we did find was that, we could, so basically what we convinced the client to do is for 12 leads, we asked them to buy pretty much all the leads from the aggregator. And that was a win-win solution for the aggregator as well, because the client was actually buying the leads which were hitherto being suppressed, so they were actually getting a little bit more money out of that. But what we did manage to find doing that was that the leads that they would have suppressed are actually leading to a decent amount of conversions. So they were basically not looking at a segment of the universe which could lead to conversion, which could lead to paid policies because of their business as usual practice. So that was one of the good things that we found out of the model as well. So once we built the primary version of the model, then it becomes the application of utilizing the model for the 3 different aggregators, because we had to actually take the results of this model back to the aggregator so that we could start some discussions about performance-based pay. So, we were not going to be saying that for pretty much all leads, I'm going to pay like 50,000 yen or whatever the price is. We want to be able to equip the client with a tool which says that, hey, if this lead is going to be more productive, I'm going to be bidding a little bit more for this particular lead than some lead which is not scoring very high. And if you think about it, this is very, very similar to the concept of real-time bidding in display, because I want to be able to pay a little bit more money for a particular impression than others. So the concept here is exactly the same. And what we did see was that when we actually applied the model on the 3 different aggregators, the model is obviously holding up very well. And also for Kakaku, one of the major lead providers or lead aggregators, we saw very distinct lifts in the first 3 or 4 tiers. And then we also started talking to the client about, hey, why don't you actually start using this model more as a selection mechanism rather than just a suppression mechanism. So there is another business application that the model kind of threw up. So what we did find was that pretty much across all the major aggregators, we could retain, like I said, about 85 to 90% of the conversions with only about 70%, 67 to 72% of the leads that we were originally buying. So basically that automatically drops down your cost per lead by a significant amount. Then once we started getting the data, and like I said, it was very important to be able to test the chain model on what we call a completely unbiased universe. So basically there was no business rule-based suppression being made for the 12 to 14 weeks. And we started getting a significant amount of conversions, like I said, from the leads that I would have never gone after. But once we actually had a decent amount of performance data from the 3.5 months, we actually utilized the data for a regression model. And the regression model is actually showing, as you would expect, much better results than the chain model that we had. So The regression model, if you see the validation diff rates in the lower sort of, box, in pretty much like, all the top deciles, the regression model is showing a much, much better variation, a range of lift. So one of the things that, we also did during this time was that since this model was being implemented pretty much on a real-time basis, we used to actually receive a daily feed of all the scores. We had automated the scoring on our end, and we would kind of, compare the scores that we received from Japan, run it within like, 30 minutes, and then basically send them a yay or nay of, hey, the scores are looking all right versus the scores are not looking all right. So there were only like, one or two instances where the score did not look all right, and we kind of, fixed that. But mostly, like, checking this for a period of almost like, 90 days, once we satisfied ourselves that, the scores are being implemented correctly, then the regression model actually views some derived data, interaction effects, like, typically things that you would use in a regression model. So one of the big wins out of this project was that the way we set it up was there was a very clear comparison between what was happening versus what we could actually get by employing this, new methodology. So the measurement piece was extremely important. So what we did, like I said, was, the model was being constantly validated in real time across all the major lead aggregators. We were scoring the model and validity on a daily and a weekly basis, and the lead conversion, we were basically, since we were doing it also on a daily and weekly basis, it also led to the concept of the conversion curve, like, how long does it take for a person to convert who is coming through, like, different areas, through different channels, different segments, and that's like, another application which we are talking to the client now. But one of the biggest things which came out of here, and which is, almost like a paradigm change in the insurance industry in Japan, is our client has actually started talking to the aggregators on, not on a wholesale basis, but a pay-per-performance basis. And that, we believe is going to be a game changer. And we were actually out there just like, a couple of weeks back, and we are seeing, the evidence of the model. There is a huge amount of, interest from the client in the deployment of analytics. So what we did was we looked at what are like, some of the returns out of this model. So straight off the bat, it is a very objectively measured ROI. The ROI that we got out of this project was almost like, 15 times. So basically the savings that they had, just the savings that they had by suppressing the unproductive leads, was about like 15 times the cost of the product. Like I said, you can always get pretty much the similar amount of conversions by using, paying a lot less for the leads, because you can suppress some of the unproductive leads. That decreased the CPA by 25%. The other big thing, like I said, was we estimate that we could actually get about 1,500 new policies from those segments that we were suppressing before, and doing an average premium of each of these 1,500 policies, we could generate about 60 million yen in additional sort of, written premium over the period of a year. So that was, some of these things were actually showed to the executive management in Tokyo, to the client, and there was a lot of buzz. And what we feel is that, like Yanni pointed out, it's a very sort of new environment for deployment of advanced analytics. So instead of doing something very fancy, I think we deliberately chose something easier for them to understand as well as easier to deploy. And the results are very good, so we are hopeful that this will lead to like a lot more further engagement with the client.
And the key here is that the data is one of the biggest constraints, especially in Japan. There is data at the customer level, that it exists in a walled environment. The same way, because analytics exists usually in a walled environment, the maturity is still at a very, primary level, and there is a lot of upside doing even basic advanced analytics with a limited amount of data. So the same client in the US, the same international client in the US, is doing medium mix modeling, utilizing full regression and Bayesian techniques. So they're very advanced in other parts of the market. And then when you are in a location, in a region, actually a very important region that generates probably 80 to 90% of all international revenue for that client, you tend to kind of like revert into an environment where you're still at the beginning of the analytics exploration. Any questions?